Welcome to the deep dive. Today we're going to be cracking open The Intelligent Investor.
By Benjamin Graham.
By Benjamin Graham, yes.
Yeah.
It's pretty much a legend in the investing world, and we're going to try to unearth the wisdom that's made it a must-read for decades.
Yeah. This deep dive is custom made for you. So whether you're, prepping for a meeting or brushing up on your investing knowledge or just plain curious, we've got you covered.
I've got to admit, the title makes me wonder if this is just for, financial wizards. What does it even mean to be an intelligent investor?
That's where it gets really interesting. Graham actually says that intelligence in investing isn't about like a sky-high IQ. It's about your character traits.
Oh, interesting.
Yeah, things like patience and discipline, a hunger to learn, keeping your cool and thinking for yourself.
So it's more about mindset than like being a math genius.
Exactly, yeah. And he illustrates this with a fascinating story about Sir Isaac Newton.
Wait, that's Sir Isaac Newton?
Yeah, the gravity guy.
Lost money in the market.
He did. Got caught up in the South Sea bubble.
Oh, wow.
And just ignored any kind of rational valuation and lost a fortune, millions in today's dollars.
That's a pretty strong argument for emotional control.
It is. Yeah. And it kind of highlights the difference between investing and speculating.
Right.
An investor focuses on the actual worth of a business.
Uh-huh.
While a speculator is just kind of betting on market whims, hoping for a quick win. And Newton's story kind of shows how that rarely ends well.
So lesson 1, don't try to outsmart the market. Focus on the real value of the business.
Right. And to do that, he introduces this concept of mine of safety.
Okay.
It means buying assets for much less than their true value.
Okay, so like scoring a deal at a killer sale, but for stocks. This is starting to sound like something I can actually use.
That's exactly it. Imagine snagging a business worth like $400 million for a mere $80 million. That's the power of that margin of safety.
Yeah.
It protects you from losses and even from being wrong in your estimations.
Yeah.
You don't need to predict the future perfectly. Just find a good deal.
Okay, that makes sense. I can see how that can help even experienced investors make clearer decisions. What about growth stocks? I mean, those are supposed to be the hot shots, right?
They seem that way, yeah, with all the hype surrounding them. But Graham was actually pretty wary of growth stocks, especially when their prices were really high.
Yeah, but why is that? I mean, isn't growth a good thing?
Yeah, growth is great in theory, but those really high prices, they often rely on overly optimistic guesses about the future. And as we've seen, the market's mood swings wildly, which can really impact those valuations.
So those high-flying growth stocks could come crashing down.
Absolutely they can.
Yeah.
We can take Texas Instruments in the 1950s as an example. It was the growth stock.
Right.
Went from like $5 a share to $256 a share without even paying dividends.
Oh, wow.
And then earnings got cut in half and it plummeted back down to $49 in just 2 years.
Oh.
Yeah.
So chasing those exciting growth stocks might be more like gambling than investing.
That's a good way to put it. You're betting on a very specific future that's often uncertain.
Yeah.
Instead, he kind of suggests focusing on undervalued assets.
Mm-hmm.
Businesses trading for less than they're actually worth. The intelligent investor kind of buys these and holds them and lets the magic of compounding work over time.
So it's about playing the long game, building wealth steadily instead of looking for those quick wins.
Exactly. It's a marathon, not a sprint.
Right.
How would you picture building a defensive portfolio, one that can kind of handle those market swings?
Well, I know diversification is important.
Yeah.
Spreading your investments across different types of assets to reduce risk. But how do you actually put that into practice?
Yeah. Graham recommends a balance of high-grade bonds and a diverse selection of leading common stocks. He suggests investors never have less than 25% or more than 75% of their funds in either.
Oh, wow.
And keeping a corresponding range in the other.
So a 50-50 split could be a good place to start. That seems simple enough.
Yeah, it is, yeah. And the beauty of it is you don't need to constantly tinker with your portfolio based on every market hiccup. You just rebalance it periodically to keep your desired asset allocation.
So if the stock market goes up, you sell some stocks and buy more bonds to bring it back to 50-50, and then vice versa when the market goes down.
Precisely.
Okay.
This forces you to buy low and sell high.
Right.
Which is a key principle for success in investing.
But how do we choose the right stocks for this portfolio? Do we just throw darts at a list?
Dart throwing won't cut it, that's for sure.
Okay.
He suggests looking at companies with consistent earnings, a solid history of paying dividends, and a reasonable price relative to their assets and earnings.
So no shortcuts. We need to do our research and understand the businesses we're buying into.
Absolutely.
Yeah.
For example, back in the 1970s, Graham saw potential in utility stocks, which were kind of overlooked at the time, but they met his criteria. Undervalued, consistent earnings, and a history of paying dividends.
So even back then, there were those hidden gems to be found if you knew where to look. I bet those utility stocks did well over time.
They did. They outperformed the market, showing that focusing on value and ignoring hype can really pay off big time.
Now let's talk about investment funds. Are they a good option for the intelligent investor?
That's a good question, yeah. Aren't they supposed to be managed by professionals who, know what they're doing? Does Graham think they're worth it?
You'd think so, right?
I mean, that's what I thought too, right? Aren't those fund managers, with all the fancy tools and expertise supposed to be able to, beat the market?
Well, you would think so, but Graham was actually pretty cautious about funds.
Oh, really?
He pointed out that the average fund often doesn't do any better than the market itself.
Why is that? It seems like they have, every advantage.
Yeah, well, he kind of identified a few reasons for their underperformance.
One, high fees eat into returns. Two, frequent trading can be counterproductive. And then, they have a tendency to chase those hot stocks we talked about, which, can really backfire.
So even with, expert management, success isn't guaranteed.
Exactly. And that's why he stressed the importance of carefully choosing funds that, match your investment philosophy, have a solid track record, and keep fees low.
It makes sense. It's kind of like hiring a contractor or something. You wouldn't just pick anyone without, checking their references and experience, right?
Precisely, yeah. And just like with, individual stocks, don't get swayed by, fancy marketing or promises of huge returns.
Right.
Stick to your principles and choose funds that have a history of delivering, consistent long-term results.
Okay, so we've covered a lot of ground.
Yeah.
We talked about what makes an intelligent investor, the importance of margin of safety, the perils of those growth stocks, building a solid portfolio, and even the role of investment funds. What else should we dive into?
I think it's time to explore the art of security analysis.
Ooh.
This is where we, put on our detective hats and search for those hidden investment opportunities.
Ooh, I love a good mystery. But we said earlier, it wasn't all about, complex financial ratios. So how does security analysis help us find those hidden gems?
Right. It's not just about crunching numbers.
Yeah.
Security analysis, as Graham explains, it's about understanding the true worth of a business, not just following market trends or predictions.
So we need to look beyond the headlines and the hype and really understand, what makes a business tick.
Exactly.
Oh.
Graham actually provides, a great example using two similar companies from 1968, National General and National Presto.
Okay.
And by analyzing their financial statements, he shows how to identify undervalued opportunities.
So this is where those aha moments come in, right? By developing these analytical skills, we can spot those hidden gems that the market might be overlooking. I'm getting excited about this.
Me too.
I am too. This is what makes investing so fascinating. This constant process of learning and discovery. And yes, those aha moments.
Yeah.
When you find a truly undervalued opportunity. Before we go full-on detective mode with the, financial statements, can we explore some of Graham's case histories? I think seeing, these real-world examples would really bring these principles to life.
Absolutely. They're like mini detective stories themselves, full of twists and turns, and each one has, valuable lessons for investors.
Mm-hmm.
One that comes to mind is the case of AAA Enterprises.
Okay.
They went public in the 1960s, kind of riding the wave of the, the franchising craze.
Right.
And their stock price doubled just after going public, purely based on speculation.
So they had the hot buzzword of the moment, but was there anything substantial behind it?
Not so much. The business lacked a solid foundation. And within a couple of years, it went bankrupt, leaving investors with nothing but, broken promises.
It sounds eerily familiar to some of those, .com crashes back in the late 90s.
It does, doesn't it?
Yeah.
Yeah, history often repeats itself.
Yeah.
Investors get caught up in the excitement, ignore the basics of valuation, and end up paying the price.
So lesson 1 from the case files, be careful of those buzzwords and market fads. Don't let the hype, cloud your judgment. What else can we learn from these stories?
Another intriguing case is Penn Central Railroad. It was this, massive company that seemed untouchable.
Right.
long history, substantial assets, and a seemingly strong, financial position.
But they filed for bankruptcy in 1970, so what went wrong?
Yeah, despite the impressive facade, they'd been making some questionable decisions, using creative accounting to kind of hide their worsening financial health.
So they were basically cooking the books, making things look rosier than they actually were.
Essentially, yes.
Mm-hmm.
And this emphasizes how crucial it is to look beyond the surface. We need to dig into the details of a company's financials and really understand how their business works.
Okay, lesson 2. Don't be fooled by appearances. Due diligence and scrutinizing financial statements are essential.
Yeah.
What other red flags should we be watching out for?
Let's jump ahead a few decades to Tyco International.
Okay.
This conglomerate, grew incredibly fast in the 90s by acquiring, tons of other companies.
Oh, Tyco. I remember them. They seemed to be buying everything in sight.
They were on a buying spree and their stock was soaring. But hidden in their complex financial statements were these massive non-recurring charges. Basically, expenses related to all those acquisitions.
Okay.
They're supposed to be one-time things, but they kept popping up year after year.
Some more creative accounting, trying to, smooth out their earnings.
Essentially, yes.
I'm starting to think I need to brush up on my accounting skills.
It's a good thing to be aware of. And those non-recurring charges, especially for companies that are doing a lot of acquisitions, can be a warning sign.
Right.
The intelligent investor should always be skeptical and carefully examine those.
Okay, so lesson 3. Watch out for companies constantly making acquisitions and racking up those non-recurring charges.
Right.
It could be a sign of trouble lurking beneath the surface.
Exactly. Now let's shift gears a bit and talk about, investor activism. It might seem a bit out of place in a book about value investing, but Graham believed that shareholders, have a duty to hold corporate management accountable.
Wait, so it's not just about buying stocks and sitting back. We should be like active participants in the companies we invest in.
That's right. Things like attending annual meetings, voting on, proxy issues, which are basically, proposals voted on by shareholders, and engaging with management can help protect shareholder interests and make sure businesses are run, responsibly.
That makes sense. But what if you're not like a financial expert? Can the average investor really make a difference?
Absolutely. Even if you're not, a financial whiz, you can still ask questions, voice your concerns, and hold management accountable. And, you're not alone in this. There are lots of resources out there to help investors, understand their rights and exercise their influence as shareholders.
Okay, lesson 4. Don't be passive.
Right.
Be an active owner and take part in the companies you invest in. Sounds like there's power in numbers.
There is, yeah. Your voice matters. And by engaging with management, you can help ensure that businesses are run ethically and in the best interests of all shareholders.
This is giving me like a whole new perspective on investing. It's not just about, picking stocks. It's about being part of something bigger.
Exactly. And that brings us to another, crucial topic, market fluctuations. How should an intelligent investor navigate those inevitable ups and downs?
I mean, that's the $1 million question, right? Like, how do you stay calm when the market seems like a roller coaster?
Yeah.
What does Graham suggest?
Yeah, well, he emphasizes that market fluctuations are just part of investing. They're not something to fear.
Okay.
But an opportunity.
An opportunity. But what if the market crashes? Won't I lose everything?
Well, remember, the intelligent investor is focusing on the underlying value of a business, not those short-term swings in the market. Yeah. So if you've bought a stock, for significantly less than its intrinsic value,
okay,
a market downturn simply gives you a chance to buy more at an even better price.
So it's like a giant sale at your favorite store, right? Prices are slashed, and you can stock up on those bargains.
Exactly.
I like the way you think.
Yeah.
I get it, but it's easier said than done, right? It's got to be tough to stay calm when everyone else is freaking out. What did Graham suggest for staying emotionally balanced during those wild times?
He has this brilliant analogy. He personifies the market as Mr. Market. This, manic, depressive guy who's constantly offering to buy or sell your stocks at crazy prices.
So Mr. Market is that unpredictable neighbor who's always trying to sell you junk you don't need or buy your prized possessions for pennies.
Exactly.
I think we've all met someone like that.
Yeah. Graham's point is, you don't have to play Mr. Market's game.
Right.
You can ignore him when he's being irrational and only deal with him when his offers make sense.
So it's about being in control of our emotions, not letting Mr. Market dictate our actions. We decide when to buy or sell based on our own analysis, not the markets, like, mood swings.
Yeah.
Exactly.
Now, that's empowering. This is all starting to click for me.
Yeah.
But let's be real, right? The market can be incredibly unpredictable.
Yeah.
So what about those, unexpected events, like those black swan events no one sees coming? How do we protect ourselves from those?
Well, as we discussed, that margin of safety is our best defense against the unknown.
Okay.
By buying assets for less than their true worth.
Okay.
We create a buffer that can kind of absorb those unexpected shocks.
So it's like an emergency fund for our portfolio.
Yeah.
A cushion for those financial storms.
Exactly, yeah. And this is where diversification comes in too.
Right.
By spreading our investments across, different assets, we reduce the impact of any single event.
Okay.
Whether it's a market crash, a natural disaster, or even a scandal within a specific company.
I'm starting to see the bigger picture here, right?
Yeah.
It's not about trying to perfectly predict the future or outsmart the market.
Right. It's about building a strong portfolio based on solid principles that can withstand those bumps in the road.
You got it. And Graham actually stresses that the intelligent investor shouldn't just focus on the numbers,
Oh.
We should also consider the qualitative aspects of a business, like the integrity of its management and its long-term prospects.
So it's not just about the financials, right? We need to look at the people running the show and their vision for the future.
Absolutely. And he gives, some insightful examples of companies that looked great on paper, but, had hidden issues that eventually led to their downfall.
So lesson 5, look beyond the numbers. Consider the quality of management and whether the business is, sustainable over the long haul. It's about finding companies built to last, not just those with flashy, short-term results.
You're getting it. Now this brings us to a point that Graham emphasizes throughout the book, which is, the importance of temperament.
Temperament. You mean like having a calm and patient personality?
Is
that something you can learn?
Yeah, exactly. The intelligent investor doesn't get swayed by the emotions of the market,
Right.
by fear or greed.
Right.
They can stay focused on their long-term goals and make rational choices, even when everyone else is losing their cool.
So it's not just about being smart with numbers. It's about being emotionally intelligent too.
Yeah.
Being able to control those impulses and make good decisions even when things get stressful.
Yeah, that's a great way to put it. And Graham argues that developing this temperament is just as crucial as any financial skill. He believes it's the single most important factor in achieving, long-term success in investing.
Wow, that's powerful. But let's be honest, most of us aren't, born with that kind of calm and rational temperament.
Right.
Can we learn to develop it?
Absolutely. He suggests a few strategies. One is to really understand, market history,
right?
By studying past cycles of boom and bust, you kind of get a better perspective on the present.
Yeah.
And realize that these fluctuations are just a natural part of the game.
So knowledge is power, right? The more we learn about how markets have behaved in the past, the less likely we are to panic when things get volatile today.
Exactly. Another strategy is to kind of keep your eyes on the long-term prize,
right?
By setting clear investment goals and reminding yourself, why you're investing in the first place. You can avoid getting caught up in the short-term, noise and distractions.
It's like having a vision for the future, right?
Yeah.
A roadmap for where you want to go financially.
Yeah.
And that vision kind of guides your decisions even when the market throws you curveballs.
Yeah, that's a great way to think about it.
I love it.
Yeah. And remember, investing is like running a marathon.
Right.
Not a sprint. It's about building wealth steadily and patiently, not chasing, quick riches or trying to time the market perfectly.
This is all making so much sense. I feel like a weight has been lifted off my shoulders, But before we move on, I've got to ask about luck. Does it play a role in investing, or is it all about, skill and discipline?
That's an interesting question, and one that Graham, addressed directly. He believed that skill and discipline are essential.
Okay.
But acknowledge that luck, can play a role, especially in the short term.
So sometimes you just get lucky. You pick the right stock at the right time, and it takes off like a rocket. We all dream of that.
It happens, and it can definitely boost your returns.
Right.
But Graham emphasized that over the long term, skill and discipline will always win out over luck.
It's like that saying, the harder I work, the luckier I get, right?
Exactly.
Yeah.
The intelligent investor focuses on what they can control, their knowledge, their discipline, their temperament, and by mastering these, you increase your odds of success and reduce your reliance on just being, lucky.
Wow. This has been an eye-opening deep dive. I feel like I have a whole new perspective on investing.
Yeah.
One that's based on sound principles and rational thinking and emotional intelligence.
Yeah.
What final words of wisdom would you leave our listeners with?
I think Graham said it best. The intelligent investor is a realist who sells to optimists and buys from pessimists. Remember, investing is not about speculation or trying to predict the future. It's about patience, discipline, and a constant focus on value. By embracing these principles, you can, become a truly intelligent investor, capable of building wealth, steadily and confidently, no matter what Mr. Market is doing today.
That's a perfect note to end on. Thank you so much for joining us on this deep dive into the intelligent investor.
You're welcome.
I hope you found it as insightful and inspiring as I have.
Me.
And remember, the journey to becoming an intelligent investor is ongoing.
Yeah.
Keep learning.
Absolutely.
Keep exploring and never stop seeking value in a world of noise and distractions.
Couldn't agree more.
Until next time. Happy investing. All right, we're back for the final part of our deep dive into the intelligent investor.
Yeah.
I'm really curious to hear your thoughts on that cliffhanger we left off with.
Yeah.
What industries would Benjamin Graham think are undervalued today?
That's the question, isn't it? If we're channeling Graham, we have to remember, he was a master at finding value where others weren't looking,
Right.
He wasn't afraid to kind of, go against the grain,
right,
and explore, those overlooked or out of favor sectors.
So we need to think outside the box.
Yeah.
Venture beyond the usual suspects like tech and healthcare.
Exactly. And we also need to consider, the current economic landscape, right? Think about industries that might be, temporarily undervalued because of, short-term challenges or negative sentiment.
So it's like hunting for those diamonds in the rough businesses,
right,
with strong fundamentals that are being unfairly punished by the market.
Yeah.
So where do we even begin our search?
Well, I don't have a crystal ball.
Right.
And I can't say for certain what Graham would pick today.
Right.
But, based on his principles, I think a few areas might intrigue him.
Okay, let's hear about these potential treasure troves.
One area that I think might, pique his interest is the energy sector.
Okay.
Specifically, companies involved in traditional energy sources like oil and gas.
Interesting. But aren't those industries facing a lot of pressure with the shift towards renewable energy?
They are. And that's precisely why they might be undervalued, right?
Yeah.
The market is so focused on, the future of renewables that it might be overlooking the value and cash flow that these, traditional energy companies are still generating.
So it's like the pendulum has swung too far in one direction.
Yeah.
And that creates opportunities for value investors to capitalize on the other side.
Exactly. And remember, Graham loved companies with strong cash flow and tangible assets,
right,
which many of these energy companies have in spades.
That's a really good point. What other industries might be on Graham's radar?
Another area I think he might explore is manufacturing.
Okay.
Particularly companies involved in essential industries,
Okay.
Those producing goods that are always in demand.
So the companies that actually make things, the backbone of the economy.
Precisely. These companies often have, solid fundamentals, strong balance sheets, and a history of paying dividends.
Right.
All qualities that Graham valued highly.
But isn't manufacturing also facing challenges from globalization and automation?
It is. But those challenges may be creating, opportunities for value investors, right?
Mm.
The market might be undervaluing those well-managed manufacturing companies that are adapting to these changes and staying competitive.
So it's about finding those resilient businesses.
Yeah.
The ones that can weather the storms and come out, stronger on the other side.
Exactly. And remember, Graham was a contrarian thinker.
Right.
He wasn't afraid to invest in industries that were out of favor as long as he saw underlying value that the market was missing.
I see. It's not about following the crowd. It's about, doing your own research,
Right.
and making decisions based on the facts. What other industries would fit this mold?
One final area I think Graham might find interesting is the financial sector, particularly banks and insurance companies that are, well capitalized and conservatively managed.
Now, that's an interesting one. Weren't those companies kind of at the heart of the 2008 financial crisis? Why would Graham be interested in them now?
That's a fair question. And of course, the financial sector has gone through a lot of changes since then.
Right.
But Graham always believed that banks and insurance companies, when managed well, could be solid, long-term investments.
So it's about finding those institutions that have learned from the past.
Yeah.
And improve their risk management and are committed to responsible lending and investing.
Exactly. And often, these companies trade at attractive valuations and offer decent dividend yields, making them potentially appealing to the intelligent investor.
This has been such an eye-opening, exploration. I feel like I've gained a whole new toolkit for navigating the market and finding those hidden gems.
Yeah.
But before we wrap up, I want to kind of circle back to one of Graham's core principles, the margin of safety.
Yes. The cornerstone of his philosophy, yeah. The principle that protects us from those inevitable mistakes and uncertainties,
Yeah, you mentioned earlier that it can also be like a simplification tool, right? A way to make investing feel less overwhelming.
Precisely. By focusing on a margin of safety.
Okay.
We don't need to be, perfect in our predictions or valuations.
Right.
We just need to find those opportunities where the price is significantly lower than our estimate of intrinsic value.
So it's like having a built-in buffer, a safety net to protect us from those unexpected, bumps in the road.
Yeah, that's a great analogy.
I like that.
Yeah.
And this principle can be applied not only to individual stocks, right?
Right.
But also to entire portfolios,
Yes.
by making sure our overall asset allocation is balanced and diversified.
We create a margin of safety that can help us weather any market storm.
Yeah.
This has been an incredible deep dive. I feel like I've gained a whole new perspective on investing. One that's grounded in sound principles and rational thinking and emotional intelligence. What final words of wisdom would you leave our listeners with?
Well, I think Graham said it best. The intelligent investor is a realist who sells to optimists and buys from pessimists. Remember, investing is not about speculation or trying to predict the future.
Yeah.
It's about patience, discipline, and a constant focus on value. By embracing these principles, you can become a truly intelligent investor, capable of building wealth, steadily and confidently, no matter what Mr. Market is doing today.
That's a perfect note to end on. Thank you so much for joining us on this deep dive into the intelligent investor.
It was a pleasure to be here. I hope you found it as insightful and inspiring as I have.
Thank you.
And remember, the journey to becoming an intelligent investor is ongoing. Keep learning, keep exploring, and never stop seeking value in a world of noise and distractions. Until next time, happy investing.
Ooh.